Welcome back. Amy is in North York. Go ahead, Amy.
Oh, hi, David. Good afternoon. I like your opinion on Walt Disney. I own the stock. I probably made about 10% on the return, but he's like two sides of the story that, a lot of people talking about the hangover from the ESPN. So I was just wondering if I should hold the stock or just take the profit.
Okay.
I'll hang up and listen. Thank you.
So, Amy, recently in the last two or 3 weeks, stocks pulled back just about 10%. And certainly there are people who are concerned a little bit about ESPN and subscribers. On the other hand, they've got lots of great product coming out over the next year. At this point, the stock's sitting virtually right on the 150-day moving average, which is sloping higher. So that's a smooth moving average of the last 150 days. Many people use that as a long-term trend indicator. If I owned the stock here, I like media. I like sort of leisure within consumer discretionary. I would say the 150-day moving average, which is around 107, 106, would be do or die. And if it were to break that level, I would probably go to the sidelines only because there may be other things to do in the near term that might be more interesting. You don't need to own a stock that's technically broken in a decent market. Having said that, it's above the 150-day. Technically, it's okay, and it has given you a pretty good pullback. I don't think you need to sell it here.
Okay, let's go to Dan in Windsor. Go ahead, Dan.
Thanks for taking my call. I would like to know your opinion on the CCL Industries, packaging and then labels and all that stuff. And if you're in by Friday, and I don't have a position, but if you're in by Friday, you can get a 5-for-1 stock split. And I was and they also recently gave a press release that they just hummed and hawed around it about they might take a position in this or buy this German company. They might be interested in bidding on it. So what's your thoughts on that, and do you own the stock? Thank you.
Okay.
All right, CCL.
So, Dan, CCL. We've talked about CCL a couple times in the last 2-3 months. And in those cases, I've said, I think it's a wonderful company. It's really well run. It's been a very hard company for somebody like me to own because it's not terribly liquid. It trades a couple of 100,000 shares a week. Like, this is not an overly liquid stock. If you go through a 5-for-1 split, it's going to become a lot more liquid. More shares will trade. It'll be more interesting to institutional investors. It's a $10 billion company. I don't mean to minimize. Like, this is a big business, and it's been hugely successful. When they talk about making acquisitions, they've made great acquisitions over time, and they've done a good job of integrating them. So I like the sector. The packaging sector and the label sector is one that's doing quite well. I like their management strength. They're doing very well in selling into internet retail from a packaging perspective. I would have no problem owning the stock. For me, if it was more liquid. For you, well, maybe you're huge. But my guess is this is something you can buy and have a position in.
Okay, now let's go to Stan, who's in Aurelia. Go ahead, Stan.
Hello, thank you for taking my call. My question's on the TD Bank. I know you like American banks, but the U.S. TD's has a lot of branches in the U.S., and I'm wondering if you're bullish on the TD Bank, because I would like to buy it for income. It pays a very good dividend, and I'm 76 years old, so I'm thinking of buying the TD Bank for income and for growth. Thank you very much.
Okay. So you're right. TD does have a significant exposure in the U.S., specifically in the Northeast, and they're having good success there. When I talk about being interested in U.S. banks, I'm more interested in U.S. banks, the banks that went through the crisis, the banks that had to recapitalize, the banks that became universally hated, and the banks that traded at ridiculously low prices eventually after all of that. When you look at those banks like Bank of America, today you're having a reduction in the burden of regulation, you're having a reduction in the burden of big multi-billion-dollar fines, you're having an increase in the ability to pay out earnings that they are generating but no longer have to save to build their capital base. So those are the positive dynamics for the U.S. banks. And more importantly, in general, the U.S. economy is steadily strengthening. And so those things are all good for them. TD benefits partially maybe from some deregulation, partially from an improving U.S. economy, but it is relatively more expensive than U.S. banks, and you're less likely to have the same dividend growth. So I still would look at something like of a Bank of America or a JP Morgan. You're going to get a great dividend, but much higher dividend growth. And I think that could be important if we're seeing rising interest rates going forward. I don't want to say you're not going to do okay in TD Bank, but TD Bank is trading over the last year better than only 30% of the companies in the S&P 500. It's not one of the stronger companies in the market. I know we love Canadian banks living here in Canada because they didn't get in any trouble, but it just may be that now is not the time to be focused on Canadian banks. You might want to be focused on the U.S. economy, which is more dynamic at this point and benefits in this environment a little bit better.
Okay, we're going to take a break now. We'll be back with David Burrows. He's President and Chief Investment Strategist at Barometer Capital Management. Back in a flash.